Hi, I'm Steve Van Metre, and welcome to your weekly economic update where we take about 30 minutes on every Friday to try to make sense of the markets, which right now don't make a whole lot of sense. But unlike our Monday night and Wednesday night updates, we take a deeper dive when the data is available to see what's really going on and to further validate that no, it doesn't make much sense. Let's talk about the markets. The markets make the news does not make the market, although the news reports on the market. Very big distinction between the two when you understand it. Now, the markets have always been a tool for the wealthy, the really wealthy, to take money from everybody else. It is it's a legal form of gambling in a sense. An investor is betting the share price is going up. The big player actually knows what the real numbers are. And since they know what the real numbers are, they can buy or sell ahead of what everyone else is doing. And to some degree, things like that have been outlawed, but for the most part, that's how the market works. Those who know manipulate the share prices to accomplish what their goal is. And one thing that's important to understand is the Wall Street, the financial media, they never tell you what to do at the right time. Think back to 2009. How many articles, newspaper magazines, radio shows, bloggers, probably weren't that many bloggers back then compared to now, but how many of them said, this is the best time to buy? Nope. Saw the exact opposite. Stocks are going to be bad news for a long time, may never recover, sell. Well, who is buying? Well, all the deep-pocketed wealthy people. And so what happens at market peaks is the wealthy people sell, but the media says the exact opposite. It's the time of your life to buy. We're at the beginning of the next great big bull market. The economy is roaring and booming. And that's where you gauge what the response is of market. So what did we have today? We had a first quarter GDP number which pretty much shocked even the most bullish person. I mean, nobody thought GDP number was going to come in remotely that high. Now, we could shed some light on this. We could put some real information behind the number, and we could say, according to Harold Malgrim, corrected surprising real GDP growth rate of 3.18 was posted at 3.2 today for the first quarter is a contrived illusion. The BEA used a unique inflation deflator of 0.64%. More commonly used deflator BLS of the CBIU inflation rate of 2.27%. If the BLS deflator was used, the GDP growth rate would be 1.56%, or half of the published number. He goes on to say, setting aside trade and inventory build, goods produced but not bought, the BEA says the growth rate of real final sales of domestic products was 2.53%, but if they used the proper deflator, real final sales were under 1%. And he kind of wraps it up by saying a Goldilocks moment was achieved through growing inventories, increased governmental outlays, crashing import values, and materially understated inflation. Of course, those weren't his exact comments, but he wraps it up by saying that pretty much the entire first quarter GDP number was a bunch of BS. But the market doesn't think so. Stocks went to a new all-time closing high, not new all-time price high, so they'd trade higher in the past, but they have not closed this high before. And so what is happening? The markets are pumping, buy the market, stocks are cheap, stocks are going to rally for the next 10 years. Bottom of the next great bull market is now. Look at great earnings growth, even though we've had to buy 2 trillion shares of our stock back to make them look this good, immaterial. So the fact is, look at what's going on. Big GDP numbers. Growth is about to surge. China's trade war is about to over and unleash the global fire hydrant of liquidity. Yeah, okay. But what is the price action telling us that it's not going that much higher? See, when you have monetary decelerations, when there is just less money floating around in the economy, and you have the one last marginal buyer of stocks is corporate entities. I mean, we looked at this Monday or Wednesday, I don't remember. But for the most part, over the last 4 years, the only buyer of stocks has been corporations. Everybody has been selling. And over the last 10 years, most everyone else has been selling. Corporations have been buying. So if the largest buyer of stocks is going to run out of money because the growth rate of the money supply is slowing and because the spread between short-term and long-term yields is narrow, so banks aren't as apt to lend to them, it tells you that the stock market is likely to go lower, not higher, because all the big block of buyers is fading away. Some have now saying that the big corporate share buyback game will be wrapped up by the end of this year. They just won't have the money to continue to funding at this pace. And we've seen that in the past 2 recessions. When corporations run dry on money, stock prices tank. And if you now think about it, so for the last 10 years, for the most part, corporations have been the only net buyer of stocks. Where does that mean stock prices go when corporations don't buy? See, a lot of people heading to retirement think, oh, the market's going to rally for 10 more years because that's what, the media is saying. Didn't you turn on those guys on the radio and they said, bull market is going strong. Well, why did we have a bull market? Think about it. Who drove stock prices? It was the baby boom generation. They had the wages, they had the 401k, they had stock option plans where they could buy stock, they could buy it in their 401k. And this generation, not only did they make more money than any prior generation, they saved a lot of money compared to prior generations, and they saved it in the stock market. So when you have this large pool of people over a long period of time demanding stocks, let me adjust my camera angle here. Nope, here we go. Buying stocks, it drives the market higher. But what's starting to happen this year? More boomers are turning age 7.5 every month. And with every month, it means more required minimum distribution. So the largest generation of stock buyers is going to become the largest generation of stock sellers. And we already know retail, public, been selling. Institutional money managers selling. Pension funds selling. And now even foreign investors are selling, leaving only life insurance companies, which are a small piece of the puzzle, and corporations as a buyer of stocks. And we know corporations are going to run, and we know that life insurance companies don't even buy remotely enough stock to prop the market up. Now, in an ideal situation, what would happen is prior generations would take over. So as one generation flowed out, money's flowing in from the other generation. And in this case, the boomers would then turn to the next generation, Gen X. We don't have that kind of money. Okay, skip them. Gen Y. No, they don't have that kind of money either. Who's the next biggest who is the biggest generation? The millennials. They're the biggest. They're bigger than the boomers. Yes, the generation who is largely underemployed, marginally employed, and earning less, far less than their boomer compatriots. So no, the millennials can't prop the market up either. So all these people saying the market's going to go higher and higher and higher indefinitely, we've reached the point now in stock prices where we're not getting much higher, because even at $1 trillion a year of stock buybacks, it's not enough money flowing in to push stock prices higher. See, the natural direction for stock prices is lower. And I'm like, what? How can it be? Stock prices always go up. They go up because the money supply increases. We are in a debt-based economy. There's more debt than there is money. So if all of the money creation stopped, what would happen is the debt would vacuum up the remaining money. There would be nothing but debts left, and asset prices would crash to zero, and they'd go to zero, because how can you buy a house if you have no money and there's no money in the system to get? Yeah, that goes to zero. So every day there are sellers of the market. It's just the natural course. The natural direction for share prices is to go lower. Now, the only way for it to go higher is you get inflation or you get easy money policies from central banks. But the moment they start to tighten, you turn the page of what's going to happen. So you've got this big generation that's heading into retirement, pulling money out. Corporations that are going to run out of money, and the media is telling you to put all of your money in stocks as if you are missing out on the biggest opportunity of your life. Well, you're not, because when all this is said and done, the reverse will happen. And without corporations buying all the stock back, what will happen to share prices? They're going to tank. They have to. Just think, if the last 10 years, for the most part, corporations are the only buyer of stocks, what does it mean where they be not buying of stocks? Where does it mean stock prices go back to where they were 10 years ago? Well, could be, because everyone else is selling. How are they going to keep going up? And these are real questions. So right now, what we're seeing is, despite all this money flowing into the market, the natural course of selling that goes on every day as people, pension funds and everyone else who needs to sell, the buyers aren't able to buy that many shares back because price is rising. As prices rise, they can't buy as many shares. And so now you start to infringe on the area of where the sellers are just naturally selling their shares at, and they're starting to balance out. And that's why the market's not breaking out to these huge new price highs. There's just not a flood of money left to come in and buy it. Again, not to mention, you still have the natural rate of selling that's going on. So all that's to say, those who are saying the market is going up for the next 10 years should take a look at demographics to start with, because it is not market friendly at all. The content of this video is provided as education information only and not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. Opinions expressed in the video that I'm on do not reflect the view Atlas Financial Advisors Inc. or Steven Van Metre Financial. So while we're on the slides, let's take a look at the M2 money supply. I've been really thinking about changing my opinion on this. Not that it's not right, it's just how it may be used as a market timing mechanism. And like, is that possible? It might be. I need to think about that. So it ticked up a little bit from like 3.8 or something to 3.9% on an annualized rate of growth. The 6-month rate of change was held flat at 1.7%. So you double this, and that is telling you that the money supply should be roughly at 3.5% on an annualized basis. So that's telling us this number should continue to roll down. The 3-month rate of change is at 0.57. We'll round it up to 0.6 multiplied by 4, which is telling us that this is saying that 2.4%. So you see 3.9 annualized, 3.5 annualized, saying that this number is going to go down, and this at 2.5. So the 3-month rate of change is saying that yes, this downward trend is valid, and if this 3-month rate of change goes negative, and it will at some point, yikes, watch out. The machine's running in reverse, not designed to do that. So the M2 growth just reversed its last week's. It took off 14 billion, add 14 billion to the money supply, and it is just lingering here, but continuing to slow down, and this should work its way lower. Taking a look at commercial industrial loans, I've said these two are rolling over. We looked at on Wednesday, I think, their correlation with the dollar. So the growth rate was unchanged over last week at 7.5%, but the back end rate rose to from 4.7 to 4.9, meaning that even though the growth rate was the same, it is actually slower because it's 7.5%. Did not change, and the back end number is rising. So that tells us this thing is slowing down as the graph shows, which means the bull market in the dollar is about to run dry. Maybe have one last surge, but a rolling over of the dollar is very bullish for things like gold and ag commodities. Consumer loans, looking at revolving credit cards and over revolving plans, this has moved up slightly. Despite all the claims of this big booming economy last month, we don't really see it here. So what we're seeing is consumers are slowing down the rate of charging. They're not spending as much money. This will reverberate into the economy for sure. And we'll expect this to continue to slow down as the money supply growth rate slows and as financial conditions tighten. This will be the last full month of the Federal Reserve's big tightening program, which notably we have to stop tightening because we had one of the strongest first quarter GDP numbers in a long time. Of course, as you now know, the BEA doctored it up. And as you further know, if I didn't mention it, this is the third quarter of inventory building, and you can only build inventory for so long because if you don't get sales to sell it, prices go down. There's your deflation or disinflation, lower consumer prices to move the inventory, and when they have to move the inventory, they cut back production. There slows the economy. Welcome to the earnings recession that's coming. Well, we're in it, but it's going to pass its way through the economy over the next several quarters. So all the claims of this big boom coming, nope. Not when you got inventories building. So this dropped to $3 billion. This will, like I said, this will be the last full month of the unwind, and they will start tapering this next month, and it will eventually stop at the end of September. Total savings deposits at deposit institutions is falling to 1.18%. This is scary because what this is telling us is consumers are having to save less, put less money in their savings to get by, and that is a red flag. Normally you want to see this rising to show the consumers are saving, but consumers cannot get by at these higher prices or having to cut their savings. This is not what you want to see going into a recession at all. You want to see this starting to climb, but it's not, and at some point it will, and that's not going to be good. What is surprising to me is, given the lack of volume on the exchanges, we are now down to roughly 50% of the share companies in the S&P 500 blacked out, and we're still not getting a strong amount of buying. Now, there hasn't been much reporting outside of Boeing that said they're going to cut their buyback program indefinitely. So it could be that other companies are, and I haven't heard it, no one's reported it, or they're just not talking about it. So we don't really know. But this is somewhat surprising considering all the panic of buying shares back. We've seen virtually no activity as this thing scales back. When you have lack of buyers and you have a continuous source of sellers, it tells you that share prices are likely to go down. And of course, kind of looked at from 2009, outside of foreign investors who are coming back down to the zero band of buying and selling, so they will eventually become net sellers. Corporations have been the only net buyer of stocks. These will eventually go away. Households have been buying, but they're still net sellers, and institutions are net sellers. Pension funds, institutional money managers. What happens when this line goes away? How do you get higher stock prices? That means all of these here have to go straight up. Well, how are they going to go up when more people are going to be retired? No. More people are going to be retired? Nope. And they're fickle. Foreign investors will come and go. But these are the last ones. Small caps are leading the broad equity market lower. This is the IWM, which is the Russell 2000, which is a Russell 2000 exchange traded fund. And you can see that when it is flat or trending down against a rising market, that, well, it's more right than the broad market is. Smart money has been buying volatility. I think we actually looked at this chart, but I left it in here. Maybe we looked at the other one too, or maybe I looked at them and just don't remember. But we can see the smart money has been buying volatility as the dumb money or everyone else has been shorting. And so you have one of the largest positions in volatility by the smart money. And the smart money is the smart money for a reason. They always get their money back somehow, some way. So when they're long volatility and volatility is falling, it tells you there's going to be a reversal. And they're going to make money, and they're going to unwind all of these short positions. Yes, according to FactSet, S&P 500 earnings growth, end of quarter estimates are now at -4%. You wouldn't know this looking at the stock market. The question I asked is, will actual beat estimates again? So will the actual number be better or worse than the estimates? We'll find out soon enough in the weeks that follow. But for the moment, we have seen the actual numbers have beaten. Now, will the actual numbers beat to the low, be more than -4%? So you can see the market is not pricing in any of this at all for any reason. There's no pricing of bad earnings. You might as well erase this because you never saw it. All right, let's go over to the web browser. Take a look at H.2 from the Federal Reserve website, H.8, I'm sorry. Let's look. The banks are still buying Treasury bonds to the tune of $16 billion of U.S. Treasury bonds, $5 billion of mortgage-backed securities, and roughly $1 billion of non-mortgage-backed securities. So the banks keep buying bonds, and they're buying a lot of them. You can go back to, say, a year ago, and they've added, $220 billion worth of mortgage or U.S. Treasury bonds, and people are telling us that Treasury bonds or interest rates are going higher. If they were going higher, the banks wouldn't be buying them. They would be selling bonds to raise cash to lend out. That's what they do. So this is very clearly telling us the banks are seeing something the public's not. And so that means that, of course, the banks are the smart money. They are part of them. They have more information than anyone else. And when they're buying bonds, and you can see it right there, that tells you what you ought to be looking at. I'm not going to sugarcoat it. any more than that. So as one global macro analyst has said recently, buy bonds, you'll be wearing diamonds later when the next recession's over, because he thinks bonds are going way up. And yeah, he's right. So let's take a look at the S&P 500 here. We've got about 10 minutes left, trying to get some of my windows cleared out of the way. All right, here we go. So we're back at a price high, not closing high, not a price high, because what's happening from a volume perspective, you can see volumes tapering down. It's just showing there's fewer and fewer people buying this market up. And when you have fewer people buying, eventually you get a reversal as sellers look to come in and do what's called a long squeeze. You got all these people that are long the market, and you want to squeeze them out of their position, sell the market to make a profit. I know there's a lot of people like, oh, it's buy the rumor, sell the news. Look, they'll do whatever they can to get people in the market, because the big players, they could care less if the market's up or down. They're going to make money either direction, because when everyone's piled in on the long side, they're going to sell it and force them out. And when everyone's piled on the short side, they're going to buy it and force people to buy. They're going to do this over and over again. So what you have to look at is the news has got, there's virtually nothing in the news that's not bullish. If you look at the economic data, it looks as bad as it did in 2009. Ask the average investor and they'll say, why aren't we buying more stocks? They're going up. Well, because the economic data is bad. And guess what happens once the big players think they've got everybody in? All of a sudden, the economic data, yeah, it's going to matter. It is absolutely going to matter. So we've got this closing high, weak volume. Looking at the VIX, we can see the smart money has been buying it. We can't see it here, but you can see the VIX is rounding off, looking like it's starting to go up. And so when volatility rises, share prices fall. So you have the largest short volatility position and the largest long volatility, short volatility by the dumb money, largest long volatility by the smart money. And you can guess where all the smart money is. Oh, wait, they're not here. They've been selling along the way. And how do we know that? Because corporate executives have to report their insider sales, and they are selling as fast as they possibly can. So we've got this move. This move will fade. Will we get a retest of the December lows, a break below? Will it show up short of that? Hard to say. But if the Treasury bond market has any say, stock prices are headed lower. We've seen this break through the 50-day moving average to the downside. So this is a bearish move. It is reconfirmed by a touch of the 50-day, crossed over, but look at that big move down. So again, confirming the bearish narrative. Then yields bounced off support, revisited the 50-day, rejected here, and now we're setting up a retest of their December lows. Well, guess what? If you retest the December lows on yields, you're going to retest the December lows at some point on stocks. Now, where do we go from here? Now, if we zoom out, I think this 2.475, this dashed line, is really important. 2.479 either way. Somewhere right in here, you'll notice that every time it breaks through, it comes right down to this double set of lines I've got here real quick. And if it breaks through there, and it should, that's when you get a huge unwind. But this next time, I don't think there's much strength. This rally up here in yields didn't come with much gusto. Remember, we've got the backs of the greatest economy ever, and you still can't get yields to go from more, it went up to 0.225%, 0.225%. That's all you get? Yeah, it's telling us that the bond market is headed lower, or Treasury yields are headed lower. It's going to pull the broad equity market with it. And we can see that real quick when we overlay the S&P 500. We'll even zoom out a year, and you can see that the S&P should be in the under 2,500, closer back down to the 2,400s by the time this all resolves with yield. And we've seen this happen in markets before, and we'll see it absolutely happen again. All right, let's continue on our walk down the markets. Let's look at oil and gas producers. I've said these are going to be rejected as well. These follow 5-year Treasury yields. So let's overlay them. And then you can see here. So here is oil and gas stocks. They should be headed back lower with their December lows in sight as well. So you can see they follow there pretty good. I mean, you can go back even 2 years and see they follow each other fairly nicely. And you could argue which one's leading the other, but right now it appears that yields are indeed leading. You see on the 6-month chart, the relationship is a lot closer. So yields are leading oil and gas producing stocks lower. And that just is what, I mean, you've got lumber prices, yields, oil and gas, stocks. Here, let's look at overlay the S&P 500 here. If you don't believe me, it's okay. You don't have to. It's not part of the rules of watching this is believing me. You're welcome. In fact, your own opinion is encouraged. Here you can see on a 1-year chart, the S&P's up here, oil and gas producing stocks, again, confirming everybody is saying this is wrong, and yet the public says everything else is wrong, and that's right. Well, then why have there been oil builds 3 out of the last 4 weeks in a period that normally sees crude oil draws? Doesn't make any sense. Let's look at gold, physical gold. How are we doing on time? 4 minutes. Physical gold came up, didn't get to its 100-day moving average, kind of rejected here again. This is normal. Topping pattern tries to sell, buyers come in, buyers turn out to be weak, usually. And then the next selling move down comes. So this is not the bottom yet. This is just the sellers seeing how strong the bulls are here. Are the bulls going to see this as a low and drive this higher? We'll find out. Looking at the gold mining stocks, rejected right here at this resistance level. This resistance level is a big deal because this is where everybody was buying before. So if you've got rejection, I was looking at this the other night, and I don't know why I didn't mention it in my prior video, but look right here. This line is where everybody's been buying in the past. And now if it gets rejected here, again, it does validate that, yeah, we're headed lower because this is where the buyers were. And then they became sellers here, and then this was where this just crazy straight shot up of buying happened. But now you're seeing rejection at a resistance level that was where buyers spent, back from 2016, January 2016 here, December 2016. So a year and a half of buying here is now turned into people selling. So maybe some of these people that bought here are selling, sell this down. This is where I believe the smart money is hanging out, right in here somewhere. If that is valid, then prices will come down into this roughly 18 to 1925, 1950 range, and then we'll see the buyer step in as the last of these people sell. Could be very interesting, and then this thing probably takes off from there. Once it gets out of this $23 price range, it's going to start breaking through, but it's got to go down one more time before it goes higher. All right, let's take a look at 7 to 10-year Treasury yields. Again, riding their 50-day moving average up, looking to break this dotted line here of resistance. That'll take it up to this 108 to 109 price level. And then from there, you've got a strong run at all-time closing highs. Looking at the 20-plus Treasury yields, same story here, riding their 50-day moving average higher. Again, bounced off of support. This is exactly what you want to see from a technical perspective. Tells us the next major move is this 128 to 129 level. And with 1.5 minutes left, the surprise here is these ags. And let's look at this. It looked like they were finally starting to break out. And then all of a sudden, Monday, Tuesday, Wednesday, Thursday, Friday, sell. But look at the volumes really low. And so this tells you that the sellers really aren't that strong. It's that the buyers didn't show up. Now, why would a buyer suddenly disappear? Well, maybe they had more they wanted to buy. That's a good reason why, you'd bring prices down, is you wanted to buy at this level. So it brought prices down to where it was, the recent low in March, the all-time low for this fund, and it didn't do it on big volume. And then all of a sudden found some buying today, but they let the sellers come in and sell it down. What are they looking for? Is this really a move lower? I don't think so. I think what's happening here is the buyers like this low price point, and they got a little more money they want to buy. And you see this big volume move where I said, hey, this is an indication we're almost at the bottom? I think what these buyers here are doing is they're looking to see if the sellers have some more gusto. And by bringing the price down, that might encourage these sellers to go and dump a bunch of money in, cause a volume spike, and the buyers come in and buy it. And once they do, then the buyers have filled up their inventory and now are in a position to take it higher. What did they learn this week? The sellers they're not strong. They're not selling on a strong volume here. Prices are falling on low volume, which says there's not a whole lot of sellers. So my guess is they'll linger around here for a couple more days in the next week, and then we should see it rise. If there's no further push to sell and there's no volume, this is where it gets interesting, because when you get a double volume or double bottom and the second bottom rises on low volume, that tells you that there are no more sellers, and no more sellers is what every buyer can't wait to hear. So I'm Steve Van Metre. We'll see you next week. Bye now.